Welcome to the Ellsworth Advisors monthly update for March 2022. I'm Kelly Keenan, this is Cameron Mealy, and today we will review what happened for the month of March, which actually ends the first quarter, year to date, on the economic fronts, and also how our portfolios performed, talk a little bit about what we see coming down the pipe, and kind of go from there. Cam, why don't you kick it off?
Thank you, Kelly. Good morning, everybody. Hope everybody's well out there. Kelly, really kind of two big themes we're going to talk about. That's the continued recovery of the U.S. economy from the global coronavirus pandemic and inflation. Economy appears to be doing quite well, but inflation is by far, I think, in every economist you hear from, it's their number one concern right now. If we look at the economy overall, let's look at employment. So this is according to the Bureau of Labor Statistics. Their total non-farm payroll numbers for March came out at an increase of 431,000. And that means the unemployment rate declined to 3.6% in March. Job gains continued in leisure and hospitality, professional and business services, retail, trade, and manufacturing. In March, the unemployment rate declined by 0.2 percentage points, which was a decrease of 318,000, which takes the percentage of unemployed to 6 million people. These numbers are now pretty much statistically in line with where we were before the pandemic. So if you look at March of 2020, we were right at a 3.5% unemployment rate, 5.7 million Americans out of jobs. Today, we're at 3.6% unemployment rate, 6 million Americans out of jobs. So basically, we've recovered all the jobs lost in the pandemic. The one interesting thing about that, though, is if you look at the Bureau of Labor Statistics report, there are still 11.3 million unfilled jobs in the U.S. You have 6 million unemployed, you have 11.3 million jobs. People just aren't working. They're not working at pre-pandemic levels. That's obviously going to be a drain on the economy. And one of the interesting things that's come out of this is really the struggle that we've seen employers trying to find and retain staff. So according to the CFO survey, more than 75% of CFOs polled have difficulty hiring new employees. About 3/4 of the CFOs polled said the talent shortage was impacting revenue, and about half indicated it was constraining both revenue and full capacity operations. So this employment issue continues to be a problem. You drive anywhere and it seems everybody's got a walk-in interviews, immediate hires, sign-on bonuses. I mean, it really is, it seems to be the new struggle for full employment is people just wanting to work.
Right. Part of it is just the money that was made available during the pandemic with higher prices because of inflation. You have to assume some of that's going to work itself out. So
let's talk about inflation. Again, you look at most economists polled, they view inflation as the number one risk to not only the U.S., but the global economy. We've seen it with the pandemic, with supply chain, with these worker shortages. Prices have been increasing at a staggering rate. On March 31st, the Bureau of Economic Analysis released its personal consumption price index for the year-over-year period ending February. The measure showed a year-over-year increase of 6.4%, which is almost 3 times the Fed's target of 2% inflation. Now, I might sound like a broken record, and we've seen it doing this every month over the last 12 months, but the February numbers, a 6.4% year-over-year increase in inflation, is the steepest rise since February of 1982.
Weren't we at 7.9 last month?
We were at 7.9 last month. I'm sorry, so this is the adjusted to take out the volatile food and energy.
Okay.
So 7.9 was the headline one.
What's the headline this month? I don't know yet.
They don't know yet. That has not come out yet. So regardless, by any measure, inflation continues to be a problem. It continues to eat into consumers' ability to purchase goods and services. With that, I think the situation is best summed up by recent remarks from former Fed Governor Lawrence Lindsay. This is a little bit lengthy, but I'm going to read this from an interview with CNBC. Again, this is former Fed Governor Lawrence Lindsay. I do think we're going to have a recession probably in the next quarter, Lindsay said in an interview with CNBC. Inflation eating into consumer spending power, they're going to have to cut back, he said. The former Fed governor also said the U.S. central bank was nowhere close on being able to control inflation. Lindsay said he was worried that inflation was poised to move higher, and there could be monthly prints of CPI, the Consumer Price Index, above 1%. Consumer inflation hasn't risen 1% or more for 2 straight months since the summer of 1980. That's going to push the consumer purchasing power down about 2 points on top of the 2.5 points it's already declined since the beginning of 2001. You can't have that much shock without having a recession.
Interesting.
Yeah.
Yeah, I think it's a little bit on the extreme side. To see inflation brush 9-10% in the next several months, I don't think is out of the question.
Oh, I think it's definitely going to happen. It's how do consumers react? How does the Fed react?
Exactly. At some point, it will, burn itself out. On the recession front, a couple things going on. Cam didn't talk about interest rates, but in the interest rate world, we're seeing an interesting dynamic where it's called the yield curve, which basically is looking at interest rates for different periods of time. If short-term rates are higher than long-term rates, it's called an inverted yield curve, which obviously, just from a common sense standpoint, if you're going to lend money for a longer period of time, you're going to want a higher interest rate than if you're lending it to somebody for a shorter period of time. And so typically short-term rates are lower than long-term rates. And every once in a while you get a point where shorter-term rates are actually higher than long-term rates. That's called an inverted yield curve. And we've seen that at different points on the Treasury yield curve where 2-year Treasuries interest rates are a little bit higher than 10 years. That is called an inversion. It hasn't been an extended period of time, but we've seen it over the last couple of weeks. You're hearing a lot about that in the news.
And a lot of people do believe that is a harbinger of a coming recession.
A lot of times that kind of signals a recession's coming. It doesn't cause the recession, but it's a sign that a recession is potentially recession is coming. There's different ways people measure that. Some people look at the 2-year and 10-year. The Fed really looks at the 3-month and the 10-year, which is not inverted. So there's some different signals out there, and the timing is also a big variable. So if we are actually in an inverted situation, yeah, there's a good chance there's going to be a recession, but timing-wise, it's been anywhere from 6 months to 18 months out when you actually see that recession. So we're in an interesting dynamic in that the economic landscape is changing. We're looking at a higher interest rate environment moving forward. We're also looking at a higher inflationary regime moving forward. So we've gotten really used to 2% or less inflation, which is really what we've seen since the financial crisis of 08-09. And that's historically a low number. When I started in the business back in the 90s, we had run financial plans at 3.5-4% inflation just to be safe. Well, could we end up in a 3 to 4% inflation regime for the next 10 or this next economic cycle we get into? That could be a reality, which also changes some of the investment dynamics. What worked well the last 12 years may not work so well the next 12 years in front of us. We just don't know, so we don't want to be 100% wrong. We just want to be mostly right. So we need to continue to invest in high quality companies that we know can survive through any type of regime.
Yep.
So some of the winners we had in the past, yeah, we've cut back on exposure there and really looked at more companies that should be able to survive and do the best in a more of a higher interest rate environment, more of an inflationary environment. And it's, I don't see a path where that's not going to happen for an extended period of time unless we have a major crisis and the Fed just starts printing money and, but then again, that would just lead to more inflation. So we're kind of stuck. The outlook moving forward is a lot different than what we've experienced. So, we've changed our, changed our investment approach.
Stuck doesn't mean there aren't opportunities. There are always going to be high quality companies. They're always going to make profit. We always want to have money in cash for opportunistic buying. We want to have commodities exposure. We want to have fixed income exposure. I think, what's interesting, your point is, a lot of people when they look at their portfolios, they measure it against the S&P 500, and that's what you always hear people say, well, how have you done against the S&P 500? How's the S&P 500 doing? It's hard to consistently beat the S&P 500 because it's a stock-based index, and you can't have all your money in just stocks because stocks are volatile. I think one thing that really proves out, the way we invest, and we've always invested, is that focus on quality, and that's if you look at the first quarter. According to Market Watch, the 500 stocks of the S&P 500 lost $2 trillion of value in the first quarter. So a lot of those high flyers that led the way, post-recession have had a major correction. And, $2 trillion, that's 10% of all of U.S. GDP. I mean, that's that's more than the GDP of most countries.
And it doesn't mean that they're bad businesses. It's just the way they're priced and the way the biggest companies in the S&P are priced, they're priced for a low inflation, low interest rate environment. So that pricing is really being adjusted.
And it's based on a lot of, it's weighted towards forward earnings.
Recessions, they're not bad, they're not good things. That's where your weakest companies tend to have issues. Sometimes the weakest companies go out of business, they end up getting bought by other companies. But this U.S. economy has survived every single recession we've ever had in the past, and we'll survive this one. And individuals, a lot of times, unless they're hearing on the news, they don't realize we are in a recession. So it's just something that's definitely going to affect accounts. Like I said, we're not planning. I don't see one. I disagree with Larry Lindsay. I don't see a recession coming in the next quarter. Are we going to continue to see some slowdown in the growth numbers? Yes, because we had accelerated growth coming out of the pandemic. Yeah, those growth numbers are going to slow. I think a lot of the positives of people getting back to doing what they used to do pre-pandemic, I think that still provides a lot of tailwinds to the economy. It provides a lot of economic activity.
You always, in order to move forward, you always have to take a step back.
Correct.
You always have to slow down. You always have to retrench. Then you can start moving forward again. We frankly, I hate to say it, but we need a recession. We need a slowdown. We need something to reset.
Well, we're going to get that as the Fed continues to raise interest rates, which they're going to continue to do. You probably have less of a backstop from the Fed for the markets. So, if you didn't know this was coming, shame on you. We've known it's been coming. We've kind of been positioning for it. We know we're going to take some lumps here and there, but we're not going to get wiped out. That's kind of the key. And with that, let's jump into the numbers before we keep on pontificating.
Yep.
For March, the Dow was up, just for the month, was up 2.32%. The S&P was a little bit better, up 3.58. The NASDAQ up 3.41. On the international front, obviously, I think a lot of this is pressure from the war in Europe, which is still going on. Obviously, it's not in the headlines as much, but it's still going on. MSCI, the emerging markets is down 2.52%, and actually, the developed world, the EAFE, up actually 0.12, so up slightly. Year to date, the Dow is still down 4.57%. The S&P still down 4.95%. NASDAQ down the most, still down 9.10. And NASDAQ was pushing mid-teens, in the height of the downside. Russell 2000, which is small caps, down 7.8. On the world stage, emerging markets down 7.2, and then the EAFE down 6.6. Our portfolios, dividend yield, kind of led the pack last month, up 4.8% for the month, so great outperformance there. Year to date, it's only down 1.1%. So once again, solid balance sheets, dividend producers, kind of more old world companies, and March gainers. Caterpillar up 18%, Paychex up 15%, Southern Co., which is a utility, up 12%, Edison up 10.4%, Pfizer up 10.3%. So good movers in the dividend yield. Laggards, Verizon down 5%. British American Tobacco down 4.7. We got a big bump there a month or two ago. So, year to date, British American Tobacco still up 13%. LyondellBasell, which has been a little bit of a drag on the portfolio, year to date is actually up 11.5. So that kind of drug us down last year. Edison up 11, Cat up 8, Merck up 7 for year to date. Big laggers for the year: 3M down 16%, Pfizer down 12%. Cisco Systems down 12, Eaton down 12. So, ebbs and flows based on what's going on at the individual businesses. Growth with income in March up 3%. Year to date, only down 0.7. So growth with income holding in there pretty well. Nucor's up 13 for the month. NVIDIA up 12. Berkshire Hathaway up 9.8. J&J up 7.7 for the month. Big laggards, Lennar, the home builder, they gave up some ground, down 9.7%. We're still making money in there. I think the higher interest rates probably affected outlook there, but demand for housing is still good. We're definitely not in an overbuilt situation like we were in 08, 09. Disney down 7.6, Verizon once again down 5. Year to date, Exxon's a big winner, up 35. Nucor's a big winner year to date, up 30. Berkshire Hathaway up 18, and then our commodity position, PIMCO Commodity Real Return Fund, about up 17% for the month. Year to date, big laggers: Lennar down 30, Starbucks down 22, Digital Realty down 20, and then Nike down 19. Price potential, kind of a A weak month for price potential. I was a little surprised, only up 0.66%. Year to date, down 2.77, so outperforming year to date wise. The gainers in March, not real big. Merck only up 7%, FleetCor up 6.4%, Facebook recovered 5%, T. Rowe Price up 4.6%, quick serve restaurants up 4%. Laggards, our auto dealers, Asbury Auto down 17.5, Lithium Motors down 12, CarMax down 11.5. Asbury and Lithium we've held for a while, and we've made a lot of money in both of those. CarMax, a newer buy, struggling a little bit out of the gate. Year to date, FleetCor's up 11, Merck's up 7, Boston Scientific up 4.6, V's up 2.33. So nothing really lighting it up in growth or in price potential. Facebook's a year-to-date laggard, down 34. Black Knight down 30. T. Rowe down 23. In our small cap, year-to-date or for March down 0.6%. Year-to-date we're still down 10. So we've lagged a little bit there. We did have some big gainers there. NV5 Global up 24.3. Excel Services up 18.6. Lantheus up 15.7. Laggards, Skyline Champion down 18.4, Allied Motion down 14. So kind of nothing huge up, nothing huge down. Year to date, Lantheus up 91%. We gave a little bit back last month, but still up 91. That's not bad. Anderson's up 30, StoneX up 21. Big laggards, Nova Measuring down 26, Helska down 24, Clearfield down 22.7. So that's kind of where we're at. Commodities are working well for us.
Commodities are working well.
Dividend yield portfolio is doing well.
They all held up great. They did great.
Most clients, what I'm seeing, kind of hovering around flat line, plus or minus a couple on both sides, just depending on where you're at in the risk scale. But kind of the same story as we've been, expect the inflation, expect the volatility. March was a good kind of relief month. Historically, April is usually a pretty good month, believe it or not, even with taxes coming up. I think everybody raises taxes or money for taxes previously. So taxes are going to be big this year. We had a lot of capital gains last year, so don't be surprised if your accountant comes back saying you owe money. That's because
you made money.
We had a lot of gains last year, and we're paying the price now. It's kind of a combination of the gains coming off the lows of 20, rolling into 21, so that's where we saw a lot of the gains, which now we're paying for them. But other than that, April, like I said, April is usually a pretty good month, but we have to expect volatility, and I think the next big question marks is going to be what's the Fed going to do in June? Will they raise 25 basis points? Will they raise 0.5%? Will they raise 1%? That'll be the big talk once we get into May.
So as always, thank you for your trust. If you have any questions, please feel free to give us a call. Have a great month. We'll talk to you again.
Thank you.